Hello, everybody. Good morning or afternoon, or I guess evening, depending on what time zone you're in. Many of you who are on this call are people who admit to being friends of mine, so I will say hello and appreciate that. And those of you who have not met me before in person, my name is Mike Blake, and I'm a co-founder of High Score Strategies. We're a boutique business valuation and strategy consulting firm. And we've all assembled here today to talk about granting equity. And I want to do this topic for a while because it's something I get asked about a lot, both in a formal capacity because evaluation often accompanies some sort of offer of equity to employees, and often just more informally. I think a lot of business owners are interested in offering equity to their employees, or in some cases are searching for a co-founder, but they don't exactly know where to begin. And to be fair, it is a fairly complex topic without a lot of transparency around it. So I hope that over the next 60 minutes or so, we're going to bring some clarity and transparency to that topic. So let's dive in here. Chances are very good that you're here for one of a few reasons, and most are that you have uncertainty. You want to grant equity because you're afraid of losing a key employee or resource. You're concerned that your incentives and those of your team are not entirely aligned. You might be afraid that you won't be able to ever leave or sell the business. You're afraid of bringing on a business partner that isn't the right fit. And that's one of the worst things in the world, when you make a bad decision from bringing on a business partner. And if you've been through that, you know that it's very destructive. You're afraid of effectively giving away the company. That's a catastrophic event, and one that needs to be avoided. And if you don't carefully consider how and how much and even the why of allowing others to participate in the equity of your company, any of these bad things can happen. But the good news, I do think, after we're done here today, that you're going to be armed with a lot of the tools that you need in order to execute this kind of plan with a good deal of confidence, with clarity, with knowing what you're doing, and with minimal risk, especially if you have the right advisors around you. So we have 5 learning outcomes today. The first outcome is, why would you want to grant equity? When it wasn't very long ago when handing out equity, or I want to use a different term here, allowing others to participate in the equity of the company was an extreme rarity. But with the advent of venture capital, especially in the wake of the first .com rush, equity participation in many cases has become expected if you want to retain and attract the highest level talent available. And then we're going to talk about, how do you know whether somebody is frankly worthy of receiving equity in the company, whether it's appropriate to offer equity to one individual versus another individual. How do you make that call? And I've got some ideas that I think are going to give you some clarity and some rigor around how you make that very important decision. We want to explore the various forms that equity grants can take, because there are many ways to accomplish this other than simply granting stock. And in fact, for many reasons, granting stock may not be appropriate for you, nor may it be appropriate for the recipient. We'll talk about a clear process for actually making this happen and implementing it. And then we'll talk about strategies for determining the right amount of equity to offer. It's one thing to get through this process and decide you know the who and the how and the why. But at the end of the day, the $64 million question is how much. A friend and former coach of mine shared with me this matrix of business decision making, or any decision making, where there's consequentiality, or the gravity of the decision, and irreversibility, the degree to which, if you think you've made a mistake, you can reverse a decision. And granting equity is up there akin to selling your company, licensing intellectual property, and other decisions. It is a momentous decision for your company. with potentially far-reaching implications on your personal wealth. And if you get it wrong, it's very hard and very expensive to unwind. And in fact, it may not be possible to unwind, depending on how you've structured it. And I think this is why a lot of people have anxiety around the issuance of equity to employees and others, because it's such a consequential decision, and because once you kind of make that move, it's very difficult to go back. And if you agree that this is indeed a consequential and irreversible decision, then you're in the right place. We're going to give you the tools to make sure you make that decision armed with the best information and the best approach as possible. When you issue equity, there are significant implications up and down the board, but I think the four most important ones are the implications for your personal wealth. When you share equity in your company, you are sharing the return that you were anticipating when you founded the company in the first place. And the implications can indeed be worth millions, or in a unicorn kind of case, billions of dollars. But it's not overstating the matter to frame the discussion as a multi-million dollar decision. Sharing equity in your company, depending on the form, also entails legal responsibilities. When you have new shareholders in your company, you're no longer the unquestioned emperor of the company. There are laws that govern what you can and cannot do when you have other equity shareholders that have a vested financial interest in your company. And beyond that, it is highly likely that whatever documentation you have that codifies how somebody's going to participate in the equity of your company, that documentation is going to contain restrictions and guidance on what you can or cannot do, and what you no longer can and no longer can do as the sole owner of the company. Issuing equity in your company brings with it reporting requirements, generally at a minimum to the Internal Revenue Service. And if your company is subject to a financial statement audit, it provokes financial reporting requirements as well, because the issuance of equity to employees for the last 15, 20 years has been considered an expense that must be recorded on the income statement. And there are strategic consequences as well. And most importantly, when you share equity with somebody, that's equity that you cannot share with anybody else. It means that you're foregoing, to some extent, the opportunity to share equity with, for example, an acquisition target, a joint venture, some kind of stock swap in an acquisition. So it's important to understand that when you make the decision to share equity like this, that there are profound strategic implications as well that may, in some cases, expand what you may be able to do later, and they may also restrict what you're able to do down the road. So with all of this foreboding, some of you may be wondering, maybe I shouldn't be doing this at all. And that's fair. Again, the nature of this decision is such that if you're not carefully reflecting on it and even having second thoughts, you're not taking it seriously enough. This is absolutely something that's appropriate to invest a great deal of thought, time, and energy into. So why would we do this? Well, the bottom line up top is the only reason to grant equity, and I'm talking to either as a business owner or somebody who's representing a business owner, that either you or your client is going to become wealthier as a result of sharing equity. So you may own 100% of the pie right now, but the pie is relatively small. You're only going to share equity if, as a result of sharing that equity, you're going to have a smaller piece of the pie, but the pie is going to be so much larger that your personal wealth is going to increase. Now, that may happen immediately upon sharing equity, or it may happen over a period of years. But if you don't have this in mind when you share equity, then you should pause and reconsider and consider why it is exactly that you want to share equity. Because I'll share with you, there are other ways to accomplish what you think you're accomplishing, by sharing equity. And also, sharing equity doesn't always accomplish what you think it's going to. More on that in a little bit. So I'm in valuation. It's important to touch the field of valuation, because when you're issuing equity, when you're sharing equity, you're sharing an asset, and an asset has value. And I don't know anything about any of your companies that are tuning in today. So I don't know what the value of your shares or your options is, or could possibly be. But I can give you the tools to think about it in a way that's rational and robust. And there's not going to be a test on this. You don't have to memorize this equation, but I want to throw up here that at the end of the day, valuation of a company and really most non-commoditized assets boils down to three things. How much cash profit does it generate, or will it generate? What is the risk that cash flow will be generated in the future or not? And then to what extent or what rate will that cash flow grow in the future? That's it. And if you know those three things, or at least have an informed view on those three things, and you have an informed view on the value of the company. So one thing I want to drill down here in a little bit is that the K term is always a function of risk. The greater the risk of a venture or any kind of investment, the more return that you need. Otherwise, it wouldn't be worth it to you to take that risk. That's why the return on U.S. Treasuries hovers somewhere around 5%, because ostensibly it's a low risk asset. I'm not going to get into that. I'm not going to open that Pandora's box right now, but at least that's what financial theory says. Whereas at the other end of the risk spectrum is something like early stage venture capital, and the required rates of return on those investments could easily be 60% or even higher. So the objective here must be to build value. And what I've done here is I've put together a cheat sheet of things you can consider as to whether or not adding somebody to your shareholder base is going to build value. And generally speaking, a new equity holder is going to build value either by lowering the risk of the company, or they're going to do so because they're able to increase the growth of the company. There's another facet of this I'm going to talk about in not too long, but these are the two primary levers. So you can read these yourselves, you probably have, but as a general rule, if an employee doesn't fundamentally lower the risk of the company, then I wouldn't necessarily be running to give that person equity. I'd find another way to compensate them. I'd pay them more in cash if I can. Similarly, if a recipient of equity is able to increase growth and cash flow, and they're able to do that in a way that is sustainable and somewhat rare, if not unique, that is a worthy shareholder of your company. That's somebody that structurally alters the value thesis of the company. And when we think of growth, we often will kind of drift mentally towards the concept of sales. And certainly that's a big part of it, but it's not the only way that somebody can increase growth by joining the company. They could be bringing a key technology or intellectual property to the table. That's why many startups look for a technical co-founder, because they're contributing that IP that enables the growth of the company in the first place. It may be somebody who is very well connected with the capital markets, and they can unlock growth for the company because they can unlock the capital that is necessary to fund that growth. So again, I'm not going to read bullet points here. You've already read them, but I do want to draw attention to the fact that when we think about growth, don't think in a way that only connotates sales, because there are many ways to contribute to the growth of the company, and many ways that are so valuable, that are so durable, that they do rise to the level of being viable equity candidates. So granting equity at a high level is going to translate into higher value, for example, bringing stability to leadership. Companies don't do well when there's a carousel or a musical chairs of executives and key managers. So it's appropriate to consider granting equity as a retention device, but not be overly dependent upon that. And again, as I hinted, that's something we'll talk about later. Granting equity as a way to lock in a succession plan is something that is worthy of consideration. Too many companies don't think about succession until it's too late. And the time to think about succession is not 2 years before you want to sell. Succession takes longer than that for the most part. Yeah, you can do it in less time, but it's probably going to be more expensive and more chaotic. You certainly don't want to think about it as you're putting the company up for sale, because A, it's going to be hard to find successors, and B, when people know that the only way that they can sell your company is if you hire them, you're going to find that the price for hiring them is going to be going to become very elevated. Granting equity may be important to helping the company achieve scale. It may be the only way that you can bring in the right partners, the right resources, the right employees. And again, that scale is just another way for saying growth, right? That's your G term right there. It translates into higher value because it preserves cash. Early stage companies frequently use equity grants as a tool to expand the company because they don't have the cash. Or even if they do have the cash, they need to spend the cash on other things for which equity would not be a viable currency. And so in order to preserve cash and therefore maintain sort of the dry powder, if you will, and maintain the growth potential of the company, companies decide they're going to issue equity as compensation. And then, as I mentioned before, granting equity ought to have the benefit of de-risking the company. But you can get into a lot of trouble if you don't do this correctly. As I mentioned before, granting equity is not an easily reversible decision. It may not be reversible at all. There's a potential for complacency when you grant equity. People can decide, well, I've got shares in the company, I've made it, I've got tenure, it's kind of hard for them to fire me. And that certainly can happen. And so that goes into why you have to be so careful in how you choose who's going to be given the opportunity to participate in the equity of the company. You have to make a decision as to whether the equity holder is going to be motivated to be complacent by equity, or they're going to be motivated to excel because of the financial potential that equity brings with it. So, of course, anytime you give up equity or share equity, you're also sharing control. In most states in the United States, there's a concept of minority shareholder rights. In fact, I don't know of a state that doesn't have this. And there are laws that ensure that the majority shareholder cannot trample on the rights of the minority shareholder. And so when you grant equity to somebody, you are sharing control. Now, you still, as a majority shareholder, still have a lot of leeway, but you don't have total leeway the way that you once did. Now, I would like to point out that in spite of all the dangers of granting equity inappropriately, there is some empirical evidence that companies with more diverse shareholder bases tend to be more valuable and tend to thrive, mainly because such companies are forced to create checks and balances on decision making. Again, the aforementioned minority shareholder rights that I mentioned. Such companies tend to be more growth oriented because shareholders want their company to grow. They want those shares to be valuable. If you're granting shares in a privately held or a closely held company, the only way you're realistically going to get liquid is if that company becomes so attractive that it sells out. And so such companies tend to be more growth oriented. So there's a cautionary tale. If you see yourself as a lifestyle business, it may very well, just on that basis alone, be a mistake to grant equity. And finally, granting equity may be a way to broaden the expertise of the executive team. Small companies don't necessarily have complete management teams. There are gaps, and those gaps will become more visible, more painful as the company grows. And I think that's I think that's a legitimate reason to believe that there's a good chance that a broad shareholder base is going to lead to a greater company value. So, as I sort of intimated a minute ago, the equity grant thesis is going to differ by situation. High growth companies are interested in granting equity for reasons that are different from mature companies, and the attractiveness of equity in such companies differs depending on the kind of posture that the company is taking. High growth companies, most of us know, have a certain trajectory. High growth hopefully find a strategic buyer or a motivated private equity buyer, and so such companies tend to wrap their culture around the value of the company's equity, for good or ill. And I'm not qualified to talk about organizational theory and behavior, but that certainly can enter the discussion where equity actually can become toxic within a company culture. And companies tend to want to make that base of shareholders quite expansive, because there's a sense that broad equity ownership creates broad motivation. On the other hand, mature companies tend to be much more cautious about bringing in equity holders, because although they hope to sell to a third party, that may not happen for a number of years. And there may be a desire to sell to insiders. And the decision to grant equity may in fact be driven by a desire to lock in that potential succession team. And so for more mature companies, equity holders tend to be much more exceptional than those of high growth companies. I guess if for no other reason than with a high growth company, you kind of feel like you're only going to have to live with each other for 5 years. For more mature companies, you may have to live with each other for 25 years. And just given the nature of the different nature of the time commitment alone, that's going to cause you to think about equity grants, I think, somewhat differently. Now, an important data point, I only discovered this a couple of years ago in a paper that I was reading. A common conception is that if you grant people equity, they're going to stay. But the data says differently. The data suggests that give or take the industry that you're in, issuing equity of some type lessens turnover by perhaps 20%. And I think a lot of companies that issue equity anticipate that it's going to reduce turnover by 80% or more. But the data suggests that that's not the case. And we'll talk a little bit about why that is a little bit later. But I think this data point is really important. To me, it says, and should say to you, if you're relying on equity as your primary lever by which to reduce turnover, it's probably not going to be very effective. In fact, on a cost risk analysis, it may be one of the most inefficient levers you could possibly choose. If turnover is a problem with your company, I'd be looking in other places rather than the cap table to try to fix it. So CARD has been putting out a lot of data on this. And by the way, I would highly recommend, if you're LinkedIn people like me and this kind of information interests you, follow a guy by the name of Peter Walker. He's sort of their chief data guy, I think, or one of their chief data people at Carta. And he puts out great charts that use Carta's data. And for those of you who don't know, Carta is a Silicon Valley-backed company that provides cap table management, mostly for high-growth emerging companies that have complex capital tables, and also does valuation. They're technically a competitor, but actually many of my clients are people that used to be Carta clients, because Carta is great at some things, they're just not great at others. I've referred people to Carta, so I don't want to turn this into running down Carta. I think they have a very valuable role to play in the valuation community, but they're not for everybody. So like I said, I have clients that used to be Carta clients, and I've also referred people to Carta because I think they can do a better job than some people. But anyway, why we should believe this data is that have access to the capital tables and the capital table transactions of thousands of companies across at least the United States, maybe throughout the world. So they have about as statistically significant a data set as you possibly can. Now look at this chart on the left. Look at the number of employees, the percentage of employees that leave the company, and their data goes out to, looks like 2023. If reading this chart, maybe by 4 years, and the typical vesting period for stock options is up to about 4 years, over half, almost 2/3 of employees are leaving the company. Now that's not as bad as 80% turnover, but it's another data point. And both data points are telling us that even among people that are equity recipients, expect over half of them to leave. And then the right-hand chart shows that most companies are not exercising their stock options when they leave. I think there are a lot of reasons for that. Number one, they'd have to pay cash to exercise those options. And they may not have it, or it may be financially prohibitive for them to do so. They may be leaving because the company's in duress and they feel like the options aren't going to be worth that much anymore. We don't know exactly the reasons why, but we do know that from the data, even employees that have those options are choosing not to take them with them when they depart the company. So it's more data that shows that issuing equity is not necessarily all that and a bag of chips. So when we talk about who we're going to invite to participate, I think it's helpful to remind ourselves of the difference of incentives between shareholders and employees. And I put together a couple of fairly extensive lists, but at the end of the day, it's really about shareholders are wanting to build wealth in their companies. Employees, generally speaking, want to protect employment. Shareholders want to create value, and employees want to extract value. And I don't mean that in a disparaging way, by the way. I think employees are properly incentivized if they're not owners of the company. When the company does well, they expect their rewards to increase. They're not all that impressed with their owners telling them what a great job that they did. They're much more impressed with cash bonuses. And when companies are making a lot of money and they're not sharing that with their employees, and the employees, the high functioning, the high performing employees tend to leave. The ones that feel like they couldn't be hired anywhere else stay. And as you can imagine, that creates something of a vicious cycle for the company. So what makes a good employee versus a good shareholder? At the end of the day, a great employee does their job really well, whereas a shareholder executes the business really well. Those things are related, but they're distinct, because an employee has a finite portfolio of responsibility within the context of the company, whereas a shareholder has, in theory, especially if they're a founding shareholder, they have a limitless portfolio of responsibility. And a key distinction, I think, is an employee, even the best employee, although they would be expensive or painful to replace, is potentially replaceable. Whereas a shareholder would be hard to replace at any price. And so if an employee starts to exhibit the kind of characteristics that you say to yourself, I'm not sure I could replace them at any price, that's a signal saying, well, maybe they ought to become a shareholder or an equity participant. Most of us have heard people talk about or say the expression or describe the ideal employee as somebody who behaves like owners. And they just don't happen, except for the 1 in a million weirdo that is just so innately dedicated that they're going to behave like a shareholder. But I think it's blatantly unfair to expect employees to behave like shareholders because they don't have the same incentive structure. They don't have the same risk reward structure. It's akin to calling employees family, which is nonsense. Families and businesses and organizations have different relationships, have different risk reward structures, and therefore are going to elicit different behaviors. Now, I mentioned before sort of a third path to equity in terms of value contribution, and I'm coming back to it now. I mentioned before that somebody is worthy of consideration as an equity holder if they structurally reduce risk or structurally increase the growth of cash flow of a business. The third pillar here is if a shareholder is going to contribute an asset. And we don't talk about this a lot in the financial world unless you're in banking because we're so focused on cash flow and we're so focused on income that we tend to ignore the balance sheet. But the balance sheet matters. And even though the assets that a shareholder will contribute likely will not be recognized by GAAP accounting, which is a massive weakness of the accounting regime, but that's a subject for a different webinar. Even though GAAP doesn't recognize it, that doesn't mean the assets don't exist. And so if you can frame the potential for somebody to become an equity participant in your company by asking the question, what asset are they going to contribute? And this explains why, to a large extent, issuing equity became so fashionable starting in places like Silicon Valley for silicon technology and Route 128 for biotech, because the individuals that were receiving equity were contributing assets. If you work for a software company, you're actually creating software code and you're contributing that software code as an asset to the company. You're going to continue to be a contributor of that asset or more assets like it to the company. And similarly in biotechnology, you're contributing patentable technology that there's a very good chance you have your name on that patent. And you're contributing assets to the economic balance sheet of the company. Now I'm using these as examples. You shouldn't think in a way that's limited to those particular examples, but think about how somebody contributes an asset to the company. Think about the economic balance sheet. And that may give rise to somebody becoming an equity participant as well. And don't forget about your advisors. Goodwill only is going to take you so far. Sure, I think a lot of us advise companies on a pro bono basis in exchange for going out to lunch with them once in a while or going out for drinks or doing some other activity. But if you really want an advisor that's engaged, then they need to have shares in the company. And it's not that the advisor thinks that those shares are going to become worth something. In fact, most don't. Most people I know who've accepted equity in companies as an advisor, myself included, they talk about the shares or the warrants or options they received, and it's nice, but I'm not exactly banking on it for my retirement. So it's a little bit counterintuitive, but they are a motivator to maximize the engagement of your advisors. So now we're going to get into the real detail part of the program here, because not all equity grants are created equal. Generally speaking, there are 5 kinds of equity grants. Now, there may be some sort of synthetic instruments out there of which I'm unaware, but most equity grants take the form of one of 5 forms. Stock grants, meaning outright share grants. Stock options, or often called incentive stock options or ISOs. There's restricted stock, which is like stock, but you're not allowed to sell it for a period of time. There are something called stock appreciation rights, phantom stock profits interests that are not entirely identical, but very, very, very similar, which are not stock at all, but they behave in an equity-like fashion. and then employee stock ownership plans, or ESOPs. On a side note, many people refer to stock option plans as ESOPs. You got to be very careful because people think of stock options as employee stock option plans, but that's not the correct term of art. It should be called ISOs. When you use the term ESOP, that generally refers to an employee stock ownership plan, which, as you'll see, is a very different thing. Generally speaking, as we move left to right on this continuum, the form of equity issuance becomes less company friendly. And you'll all have copies of this. You can take screenshots. So again, I'm not going to go through each one of these. We're going to go into these in a little bit more detail, but not in this particular point in the presentation. Stock grants have the benefit, I think, of being the easiest for people to get their heads around. You are either giving or you are selling shares to a third party to invite them to become a shareholder in the company. It is it's the strongest form of equity commitment because it's a commitment of equity that's more or less made now, or at least promised to us, provided that certain vesting requirements are met. Recipients like them because you don't have to explain to most recipients what it means to have stock in a company. In addition, unlike most of the other forms of equity under discussion here, the recipient of stock is entitled to legal protections and dividends. And that's one of the things I think Jessica is referring to, that once you start bringing other shareholders in the company, you can't just start taking distributions on your own anymore. You have to give equal distributions pro rata to those new shareholders. These are also very hard to reverse, mainly unless your stock grant agreement has some unusual buy-sell language. The only way you can get that stock back is to buy it back. Now, a recipient of shares may not love getting those shares because it will trigger a taxable event, unless the recipient will not trigger a taxable event. Sorry, I'm not a very good accountant. Will not trigger a taxable event, but they may choose to make it a taxable event by making what's called an 83B election. And an 83B election says, I want to pay tax on the shares now because I think the shares are going to be so valuable later on, 2, 3, 5, 10 years from now, that the tax is going to be much greater. Now, that may not be an option available if you don't have the cash to pay that tax, but it is a consideration when making when making direct grants of stock to employees or other parties. Stock options are a derivative of shares. They're not shares per se, but rather they represent an option on the part of the holder of the stock option to buy shares in the company at a fixed price, usually at the fair market value of the share on the date at which the option was granted. Although sometimes the strike price or the exercise price of the option may be higher than the fair market value of the share. You don't want it to be lower, otherwise that triggers another taxable event. They've been pretty popular over the years. For a grantor, they're a fairly flexible item. They're not quite the same as a full equity commitment because they're rarely exercised in full, as you saw from that chart that I showed you about 10 minutes ago. But the disadvantage is that recipients often don't see stock options as real. They don't feel as real as actual shares. So they don't have the same motivational effect. They don't have the same retention impact as issuance of outright shares. One benefit they do have, though, is that if they're issued correctly, they are tax deferred. And so you get to sidestep the tax issue altogether until there's a liquidity event. Next is restricted stock. Now, restricted stock you're actually issuing shares. There's nothing different about restricted shares generally than ordinary shares in an outright stock transfer, except restricted stock carries an agreement with it that the recipient will not sell their shares to anybody for some extended period of time. Now, that restriction will typically be lifted if the company is sold. That would also lead to something called accelerated vesting. Restricted stock usually comes with some sort of vesting, which means that they are not even granted right away, that you have to earn them over time and earn them with the achievement of certain milestones. They still have the same compliance requirements as stock options do in terms of tax and financial reporting. So I don't see restricted stock for closely held companies all that often. I say once every 2 years or so, I encounter a privately held company that has restricted stock, but I do see it. And it may be something to consider if you feel like you have to grant stock in order to motivate the person that you want in the company, if you want to motivate them properly. But restricted stock at least gives you some control over the disposition of those shares. But it can be a little bit of an awkward instrument. Stock appreciation rights, phantom stock, profits, interests are very similar. I'm not going to go into the minutia of how they differ. They're not all that important. The key thing to know about them is that they're not an equity grant at all. But we see phantom stock and stock appreciation, so it's easy to think that they are an equity grant, but they're not. What they are is a cash bonus that's issued to the recipient if the company's value increases, and usually only if a liquidity event occurs. So, for example, if I receive shares in a company that are worth $1 a share, and then when the company is sold, it sells for $5 a share, I have the stock appreciation right, which means I get a $4 per share cash bonus upon the liquidity event of that company. Now, I don't have a share, I don't have an option. So as the recipient, I'm not entitled to dividends. I'm not entitled to the same same legal protections as a shareholder. I only have a right to financially participate in the upside event of a company in the event that upside takes place. And I think as a result of this, I'm seeing these being issued with much more regularity, because these kinds of plans tend to reserve most of the control and fiduciary rights to the original shareholders. And I guess as long as you can convince key employees to accept these as compensation, be happy with them, then there's nothing wrong with it. There's a conception that SARs are particularly complicated. I'm not sure I see it that way. I just think that they're just more in vogue right now, and not as many people are familiar with them. But it's not my experience that these are more complex than, for example, garden variety stock options. And for the sake of completeness, but I'm not going to spend a lot of time on this, but it's important to understand employee stock ownership plans are out there. And when people talk about ESOPs, if they're talking about them correctly, what they're talking about is an equity participation plan that effectively reserves shares in the company as a retirement vehicle for the company's employees. They're bizarre. They were established in 1973, and they're actually subject to the Department of Labor and ERISA, the Employee Retirement Income Security Act. And so what happens in an ESOP is the owner actually sells their shares, either in full or a partial share, to a trust that is set up on behalf of the employees. An independent trustee is then appointed to represent the interests of the employees within the confines of that trust. The compliance requirements around ESOPs are punishing. I tell people that to set up an ESOP, start with planning to write $100,000 of checks to various financial advisors and go up from there. And the compliance requirements are ongoing. So why would anybody do that? And people do that. There are over 12,000 ESOPs in the United States right now, so there must be a benefit to it. There are primarily three benefits. One benefit is For owners that want to leave a legacy to their employees, it's a great way to do it. And many owners still want to leave a legacy and show gratitude to their employees on the way out. Second, under certain circumstances, it can be tax advantaged. And you have to consult with your accountant who knows something about ESOPs, can tell you exactly what the tax advantages are. I know just enough to commit malpractice, so I'm not going to do that while I'm being recorded. And third, in some cases, you can sell your company to an ESOP at a higher valuation than you could to anybody else. That in itself can be an entirely new webinar, so I'm not going to go into that here. But in spite of the punishing requirements for an ESOP, there are some reasons to do it in a very specific kind of niche case. So how do you go about granting equity? Once you've decided you want to do it, you decided who's going to get it, how do you do it? And I think that there's a fairly straightforward kind of 6-phase process. Determine what are your goals. Are they retention? Are they succession? Are you trying to reward people? Are you trying to position yourself for short-term growth? And I've given you some ideas as to which is the right tool for the right job. That will then inform the form of equity participation that you choose. Then you determine who's going to be in this club initially, and you're probably going to expand that club over time. You have to decide if they're going to be grants or purchases. In some cases, you may decide that you're not granting equity, but you want somebody to buy in. Nothing wrong with that as long as you have consenting adults. Then once you do that, create a plan. Hire legal counsel that know what they're doing, that is going to formally document how that plan is going to work. And then determine how much you're going to share, both in total. A rule of thumb for high growth startup companies is you typically are expected to set aside between 10 to 20% of your equity pool for employees now and in the future. Probably much less for a closely held company that's not going for that high growth venture capital sort of trajectory. And I think a sound equity plan has 7 characteristics. And I don't think this will surprise anybody. A good plan should be specific. It should predetermine how much equity is actually available. You don't want to be handing out these things on a whim. You don't want to be doing it in an anecdotal fashion. Sharing equity should be very much an intentional act. I think one condition I see missing in a lot of equity plans is setting conditions for future buybacks. A buy-sell agreement can and should apply just as much to restricted stock and stock options, and even potentially stock appreciation rights, as it would to an outright grant or sale of shares. And it should be robust, meaning that it should contemplate the expansion of the company, things becoming more complex, new opportunities, new challenges, new circumstances. One of the things that makes for a good equity plan is vesting. And most of us, I think, are familiar with the notion of time-based vesting, which is fine. Having somebody stay with the company for X number of years is an okay way to decide when shares are actually or options are actually released to those recipients. What I don't see enough and wish I did more, and I think would make for a lot of happier companies, is performance-based vesting. Time-based vesting sets a standard of receiving equity that you didn't quit, you didn't die, and you didn't make us fire you for cause. And I don't know about you, but to me, that's not a particularly high bar. I would much rather see performance-based vesting. Now, this means you have to do more work on the front end. It's going to make negotiation more difficult. You have to have a formal business plan that can articulate what those performance-based hurdles are. But it's worth the effort. And also, a good vesting plan states that if a company sells in the short term, that vesting will accelerate. You don't want to penalize employees for the rapid sale of the company, because that puts their interests at cross purposes. So a good vesting plan accounts for the potential for accelerated vesting. So finally, how do you figure out how much equity to grant? And this is important because equity is a currency. I mean, it's not a currency that you can spend on Netflix subscriptions or cars or houses or anything like that. Not usually, but it certainly is an asset with value, and it's becoming more liquid every day with the advent of secondary markets in privately held companies. And if you want the value to be set by somebody like me, you can, or you can negotiate it, or you can have a board simply set the number. Until you get to the compliance area, it really doesn't matter. It's all about consenting adults. But value does lie at the heart of the discussion, and the value discussion should center around what value is the employee bringing versus the value that they're receiving in return, which means you should have a view as to the quantified value of the equity instrument, and you need to have a view as to the quantified dollar value of the recipient, of what the recipient is contributing. Now, I'm not a big fan of issuing equity just to recognize past contributions. You know, that gets into sweat equity, and I've never seen somebody really pay for sweat equity. But I do think as a way, if you want to make that part of the calculus to recognize somebody's past contributions because you think that they will continue, then I think that's okay. Now, here are some benchmarks that I've accumulated over the years. There is no, as far as I'm aware, maybe Carta has something like this, but they haven't shared it with us, at least with the public, as far as I'm aware. But this can at least give you an idea as to where the market is at. You know, advisors tend to get less than 1% of equity, significantly less than 1%, unless they're super advisors, board members. And a super advisor board member means they may be actually taking a part-time role in the company as a management. They're out there beating the bushes to find new customers, raise capital, things of that nature. And you know, it's important to take these benchmarks in the spirit in which they're intended. They are not intended to be chiseled in stone, but to give you a starting point for a sanity check as to how much equity is appropriate to share with a particular person in a particular role at a particular point in time. And how rigidly you adhere to those benchmarks can depend on how far away you are from a liquidity event, and whether or not there's preferred stock in the capital structure that's going to be even more dilutive to the common. How risky is ownership of equity, and of course, how valuable is the recipient to the company? And I've got some benchmarks again by Carta, which I think are pretty good in terms of granting equity to advisors. Again, not the be all and end all. You may determine that a particular advisor is super valuable and you want to blow these things out of the water. Be my guest. To me, it's not a crime to overpay for something. I encourage my clients to overpay for things fairly routinely. What's not okay is to overpay and not realize that you're overpaying. It's not okay to overpay by accident, because that's not a good decision. And then I've thrown in some more data on advisor grants. So I'm hoping these will be enough that if you are contemplating issuing equity to an advisor, or you're advising someone who is issuing equity to an advisor, you can kind of triangulate what the market looks like. And I think this is the final bit that I'm going to cover here. I'm often asked to help founders figure out how much equity they ought to receive, or how equity ought to be distributed among a founding team. And it's kind of interesting that the range of equity for the first employees is not as high as I would have thought it would have been. I might have thought that first employees might have routinely gotten over 1%, but it turns out that they don't. So again, got to be careful with benchmarks because there's variability here. But the market is recognizing that there's a big difference between the founders who maybe are not paying themselves at all, so that they are appropriately retaining a large portion of the equity of the company, as opposed to somebody that is receiving cash. And when they're receiving cash, their share of equity goes down. And as more employees come on, presumably as the company is growing and the company is de-risking as it grows, the amount of equity that they are being allocated declines as well. For those of you who are statistic geeks, by the way, this looks like it's actually something called a ZIP distribution, ZIPF. So a little bit of extra geekery and no extra charge. And over time, those board member grants have actually been relatively stable. So if somebody's trying to make an argument that there's been a lot of volatility since the pandemic and whatnot, that really hasn't been the case. But what is important is that the distribution of board member equity grants is wider the earlier stage of the company. And that makes sense because the earlier stage of the company, the less efficient the market is. And so anytime you see a wide dispersion like this is really a proxy for market efficiency. So it's appropriate by the time you get to Series B, where you have probably the second round of institutional money in, that dispersion tightens up quite a bit. The company's been de-risked, and the market is now able to more credibly and reliably price the equity in that company. And founder equity is also drifting downward, interestingly enough. And again, as I mentioned, this is a question that I'm asked quite a bit. You know, when you have founder teams, how are founders sharing the equity? And here's, I think, kind of a nice benchmark to help founders understand what the market looks like for that distribution. So it's kind of interesting. And again, this follows something called a ZIF distribution. Somebody should be writing a dissertation on that. But by the time you get to 4 founders, nobody has a majority share, which has interesting implications for the dynamic of those shareholder relationships. All right, so I think with the technical issues that held us up a little bit, I do think we got in the 60 minutes. I'd love to thank you for your attention. I want to, again, thank you guys so much for coming. Thank you for engaging, making this more of a workshop and a dialogue than just a monologue. Really appreciate that. You're welcome, Doug. Great to see you. And we'll do another webinar in a couple of months. And if there's something you'd like to see me do, drop me a line. I'm open to taking requests from the audience.